In 1720, one of the smartest men alive lost a fortune. In 1929, millions believed markets could only rise. In 2008, experienced investors sold near the bottom. Different centuries, different crises. The same mistakes. Investing does not usually fail because of complexity. It fails because of behavior. New technology, new markets, new rules. But human psychology does not change. Greed still accelerates during booms. Fear still dominates during crashes. This is why beginner investors often repeat predictable errors. They enter the market with excitement. They see rapid gains. They assume skill. Then volatility appears, and reality begins to test discipline. The 5 biggest investing mistakes beginners make have appeared in every major financial event in history. In the late 1990s, the internet transformed the world. Companies with no profits went public. Valuations soared. The NASDAQ index more than doubled between 1998 and early 2000. Investors believed a new era had begun. Many beginners bought technology stocks, simply because prices were rising. In March 2000, the bubble burst. The NASDAQ fell nearly 78% from peak to trough. Fortunes evaporated. The mistake was not investing in technology, it was buying without understanding value. Beginners often confuse momentum with safety. When everyone is excited, risk feels invisible. But the higher the price without fundamentals, the thinner the margin of safety. History shows that hype fades, cash flow remains. After the 2008 financial crisis, markets collapsed more than 50%. Headlines predicted systemic failure, banks were failing, confidence vanished. Many beginner investors sold in panic. They told themselves they would re-enter when things felt safer. But markets began recovering in March 2009. By the time confidence returned, prices had already risen significantly. Those who tried to time the bottom often missed the strongest days of recovery. Research has consistently shown that missing just a handful of the best-performing days dramatically reduces long-term returns. Timing requires being right twice: when to exit and when to re-enter. Beginners underestimate how difficult that is. Time in the market has historically beaten timing the market. In 1929, many investors borrowed heavily to buy a small number of stocks on margin. When prices fell, margin calls forced them to sell at massive losses. Concentration amplified risk. Diversification is not exciting. It feels slow. It limits extreme gains. But it also limits catastrophic loss. A diversified portfolio spreads exposure across industries, regions, and asset classes. Beginners often concentrate in one stock, one sector, or one trend. If that trend reverses, the damage can be severe. Diversification is not about maximizing short-term returns. It is about surviving long enough to compound. Consider the South Sea bubble in 1720. The South Sea Company promised extraordinary profits tied to trade in South America. Speculation intensified. Prices soared rapidly. Even Isaac Newton invested. He initially made a profit, but seeing others become wealthier, he re-entered at higher prices. When the bubble collapsed, he lost a significant portion of his fortune. He later admitted he could calculate the motion of heavenly bodies, but not the madness of crowds. This mistake repeats constantly. Buying because others are buying. Selling because others are selling. Emotion spreads faster than analysis. Fear and greed distort judgment. Successful investing requires emotional control, not emotional reaction. The stock market has experienced numerous short-term crashes. Black Monday in 1987 saw the Dow Jones fall more than 20% in a single day. The COVID-19 crash in 2020 erased over 30% of market value within weeks. Each time, panic dominated. Yet over long horizons, markets have historically recovered and reached new highs. Beginners often focus on weekly or monthly performance. They measure success too quickly. Investing is not a sprint. It is a multi-decade process. Short-term volatility is normal. Long-term growth is historical. Those who exit during temporary downturns often miss the recovery that follows. The common thread behind all 5 mistakes is impatience. Chasing hype seeks quick gains. Timing the market seeks perfect entries. Ignoring diversification seeks concentrated wins. Emotional decisions seek immediate relief. Short-term focus seeks rapid validation. But wealth compounds slowly. Consider an investor who consistently invested through the oil crisis of the 1970s, through the crash of 1987, through the dot-com bubble, through the financial crisis of 2008, and through the pandemic of 2020. That investor would have experienced fear multiple times. But over decades, economic growth, innovation, and productivity expanded corporate earnings. Compounding rewards endurance. Avoiding large losses matters more than chasing extraordinary gains. A 50% loss requires a 100% gain to recover. This is why discipline and risk management often matter more than aggressive strategy. The most successful long-term investors are not those who avoid volatility. They are those who survive it. Survival allows compounding. Compounding builds wealth. The 5 biggest investing mistakes beginners make have existed for centuries. Chasing hype, trying to time the market, ignoring diversification, letting emotions take control, focusing on the short term. History has already tested these behaviors. The outcomes are consistent, markets fluctuate, human psychology repeats. The difference between success and failure in investing is rarely access to information. It is temperament. Those who manage emotion, embrace patience, and respect risk position themselves to benefit from time. Because in the end, investing is less about predicting the future and more about controlling yourself within it.